Welcome back. Let's take a look at another exercise in chapter 8. In this one, we are focusing on just two financial ratios. We will see how to calculate the ratios and analyze and interpret what it is telling us about the company. So we have selected financial data of current assets and current liabilities for Queensline and the competition in the industry. So we have current assets and current liabilities. They've asked us to calculate the current ratio and asset test ratio. So to start out, I have this laid out over here. I have the competition's numbers, the United Airlines and American Airlines numbers for those two ratios. So current ratio is current assets divided by current liabilities. So total current assets divided by total current liabilities. Now this number is given to me in the problem. My current assets are 875. So let me write down that first number over there. My current assets are 875. My current liabilities are 2638. Right off the bat, I know this is not good news. So when I do my calculation, what I have over here now is my current ratio is 0.33. So what this means is for every $1 in liability, current liability, I have 33 cents to pay off this liability. Clearly, that's not a good sign. And if you read any kind of notes anywhere, Google it, wherever, they're going to tell you current ratio 1:1 is a desirable number. That's for every dollar in current asset. If I have $1 in current liability, then I know I can pay that off. And we'll see why in a minute. We're saying it has to be at least 1:1. Most will say it should be 2:1 if you want to be extra conservative. But I don't want to sit on a lot of cash, but 1:1 is the bare minimum that you're looking for. So clearly, Queensline is not in good shape. Well, if you look at United and American, they're not doing too great either, but compared to Queensline, they're better. Or since we're looking at Queensline, we are worse off than our competition. So why is current ratio not a great ratio? Because current assets includes certain assets that are not going to convert to cash. Well, if I'm the vendor or supplier, that's a current liability you have in your books. I'm not happy if your current assets includes non-cash assets or the ones that are not going to convert to cash soon. So let's take a look at the current assets that we have over here. So let me highlight this over here for us. We have cash and cash equivalents. Obviously, we are fine with that. Current investments are those investments that can convert into cash very easily. I'm good with that. Net receivables is my gross receivables accounts receivable less allowance for doubtful account. So these receivables, I'm confident of collecting those. And clearly, these are all current as in short term, and I'll get the money. What about inventory? Well, I have to sell that and then get the cash. What if I sell that and then it's an accounts receivable and then I have to wait to collect? So this is not close to cash at all. Other current assets, it could be prepaid expenses. In the normal course, I don't expect that to ever convert to cash. I will get the benefit out of the prepaid expense, but I will not get cash from that prepaid expense. So a better ratio is called the asset test ratio, or it's also called the quick ratio. In the numerator, I have what's called quick assets. Quick assets, we include only cash, current investments, and net accounts receivable, not gross, net accounts receivable. In the denominator, we still have those current liabilities. So that number has not changed. That's at 2638. How much do I have? Now I'm looking at only these numbers over here. So let me put that in a different color here for us. I'm looking at cash, current investments, and net receivables. Add up those numbers. Well, that's going to drop from that other number we already know. It is 417. That is even worse. Okay, look what has happened over here. From 875, I've dropped to 417. Okay, so now when I do my calculation, what happens to my asset test ratio or quick ratio? It's 0.16. I'm saying I have 16 cents for every dollar in current liability. I would not want to be one of those vendors or suppliers waiting for my money with this company, Queensline. United, the number it drops obviously, but it's 42 cents. Here it's 31 cents. Better than we are, but again, the whole industry doesn't seem to be doing too good. So you want to look at these ratios in light of other information. You want to compare them to the industry and see where we stand. Clearly, this company is worse off than the industry, and the industry as a whole doesn't seem to be doing too good either. So this is how you would use the accounting information, and why when we present our balance sheet, you want to do the classified balance sheet where you group assets, liabilities, etc., so that we can do these calculations a little faster. So again, this is an example where we are using accounting information to analyze a company's financial health. In this case, we're looking at liquidity ratio, which means liquidity means nearness to cash. Do I have money to pay my current liabilities? So this gives you an idea as to where accounting information becomes useful in the finance world.